Well, thanks everybody for joining us at our quarterly chart party, where we spend a little bit more time than our normal update call, going through a few more slides and talking about a broader picture of topics. With that, we're going to get right into it. So, first things first, how we like to start every quarterly chart party. So, three things we do for clients: go-to advisor, optimize wealth, service with integrity. For us, it's exactly that. Go-to advisor. We want to be the first call whenever you're anything financially related. Optimize your wealth. Well, it's part of what we do is making sure that all those pieces that need to be in place are in place. And service with integrity, we act as fiduciaries in every and all capacities. And most importantly for us, we only take 30 accounts per team member. But with that, let's start with questions. So we're not going to be able to take questions today because this one's not recorded live. However, if you do have questions, we'll try to, especially on this presentation, we're happy to answer them and then expand on them in future calls. So, are you starting? Economic outlook?
Yep, I'll do the economic outlook first. Some fun, exciting times now. This is great to talk about.
All right.
This is when it's fun to be in this business. On the economic side, I'm going to talk about three things today. I'm going to talk about tariffs, because that's the topic of the day. I'm going to talk about our economy, what it means for our economy, and I'll also talk about inflation and what I think it means for inflation for us. But that's what most people are asking about. And the economy, is it going to slow? Are we going to have high inflation? What are the tariffs ultimately going to do to our economy? So let's start out with this first chart talking about economic policy uncertainty. This survey chart goes way back into the early 2000s. It shows what participants feel about uncertainty in the market. Uncertainty means investors and everybody, they don't know what's happening. They're not sure what's going to happen next. If you look back at 2008, when Lehman collapsed and the banking system appeared to be falling apart in front of our faces, there was maximum uncertainty. And then actions were taken and the uncertainty drifted down. During 2011, we had a crisis in Europe, a debt crisis. All the markets sold off and there was a lot of uncertainty. And then the governments made some decisions and helped fix it, and we're fine. Then COVID, the next big one, came out of nowhere. We didn't know what was going to happen. And everybody remembers, we had to put a lot of new policies together for something we've never seen before. And today it's the same thing. We had a shock roughly 2 weeks ago because most economists, strategists, and ourselves thought we were going to have a certain level of tariffs coming out from the administration. When they were announced, they were far higher and far different than anybody thought they'd be. So the uncertainty spiked again. And as you probably noticed, the market went down as well. And if you look at this chart, when the economic policy uncertainty peaks, when you look back, that's usually a market bottom. But everybody is scared right now. And why are they scared? They're scared because the tariffs that have been introduced, now we have a little more certainty now because we know what they are, even though they've been delayed again for 90 days and they'll probably be changed again. These tariffs equal 25% on imports to the U.S. If you look back, we haven't had that since 100 plus years ago. And more importantly, tariffs were increased significantly in the 1930s. And a lot of economists believe that led to the Great Depression or had a hand in it. Now, a lot of other economists and financial history buffs believe the bigger culprit back then was the Federal Reserve contracting the money supply. And I think that was more the culprit as well. But regardless, it doesn't matter. What's important here is this is new territory. There are going to be new tariffs. And we're going to talk about what that means for our economy. But comparing our economy today to the 1920s or 1930s just doesn't cut it. In 1930, 1 out of 4 people were farmers. Our biggest exports from the U.S. were cotton and wheat. And then it was machinery and petroleum products. It was basically a goods economy. Well, if you put tariffs on imports and exports, and your farmers, 1 out of 4 people can't sell their product, you're going to devastate the economy. And that's what happened. And we didn't sell a lot of machinery, a lot of petroleum. It did make the Great Depression worse than it could have been. Today, Soybeans are still one of our biggest exports from the farmers. Guess what? 1% of the United States population are farmers. So even with soybeans having a problem, it's not going to be the same problem it was 100 years ago. This is a different economy. We're a services economy, not a goods economy anymore. Most of our 70% of our economy, the GDP, is driven by services, not goods. So making those comparisons is leading you down a completely the wrong path. But let's talk about imports and exports. And let's look at the US. Do we export things? Absolutely. It's 7% of our GDP is exports. Now, we import $4 trillion worth of goods on a $30 trillion economy. So imports are about 11%. So that 11% we import is going to cost more with these tariffs. And we might buy less from overseas because of those tariffs. By the way, countries like China already has are going to retaliate against us. So that 7% we export might go down as well. But it's 7% of our economy. 93% is not exports. This is an issue, but look at the rest of the countries down there and even the European market at the bottom. The European Union, 38% of their GDP is exports. South Korea, 37%. Mexico, 33%. Canada, 26%. This is much more disconcerting, which is why Mexico and Canada are very upset about this, because their economies are highly dependent on exports. And actually, you notice Canada, Mexico, it's highly dependent on the purple or US. So this is a big issue, but much bigger issue for the rest of the world than it is for us. And I'm not saying it's a good thing, it's a difficult thing, and we're going to work our way through it. What does this mean for the economy? Well, if we look back here the last 25 years, almost 30 years, I guess, our trend line growth for the economy has been 2.1%. Okay. And if you look at the small box there, the most recent quarter, we grew at 2.4%. Now look at the right-hand side. We are 68% consumption. We're much driven by a consumer economy. Again, services. And look at exports. Net exports at the bottom, -3. We always buy more than we export. But as the components of GDP go, this is not a big part. We will have some higher prices for what we bring in. But even this trend line, coming in this year, most strategists thought we'd grow at 2% or 2.1. Now we've seen revisions down to 1.8, 1.7. That's a little below trend line. That's not a recession. That's not a disaster. In fact, we went into this economy very strong, very low unemployment, and doing above average growth. So this will be a hit to our economy, but we were in the right position for that to happen. The big concern from the tariffs is inflation. What is this going to mean for inflation and to our economy? Now, this graph shows you the next year inflation expectation. That's the dark line that has spiked a lot more. And then the next 5 years. Well, in 21-22, we did have a spike in inflation. It maxed out at 9%. And consumers were very concerned. Recently, it's been coming down, and we were all feeling pretty good about it. Now, because of the tariffs, it's spiked way up again to 6% and 4% long term. Something we have to point out here, the tariffs are a one-time thing. Even if we fully implement all of them, some of the estimates we've seen from strategists is it could take inflation from 2.4 up to 3.5, or maybe the high threes. But that's a one-time thing. We're not going to have new tariffs next year and the year after that. So it could be a one-time spike. But let's look at where we've been on inflation for the last 5 years. Inflation peaked at 9.1% in 22. So quite frankly, 4 years ago, 3.5 would have sounded great. So if we go back up to 3.5, that's not going to have a huge impact on our economy. And that, like I said, it's going to be a one-time thing. And then after that, we probably drift back below 3 easily. But look at what happened in 22. That's when the Russians invaded Ukraine. And if you look at that chart, the green bars are energy. Energy spiked up. That was a big part of the problem. After that started coming down, the next big problem was the bottom blue bars, because housing went up, or shelter as we call it. Shelter includes rents and houses. And record low mortgage rates allowed us to buy more homes and bid up the price of homes. But look there where we're at today, 2.4%. We're getting very close to the Federal Reserve's target of 2%. And shelter is coming down nicely. Shelter is 40% of that number. Shelter is not affected, they're remotely affected by tariffs. The other thing is we never had a recession to get this inflation down. So if you're telling me it's going to pop back to 3.5, we don't need a recession to get it back down to 2. We've done it before without a recession. And quite frankly, the Federal Reserve has made statements recently. Jerome Powell has said that they're not changing their outlook for lowering short-term rates. They are going to watch the tariffs, watch what happens from them, but they're not talking about raising rates. They're going to wait and see. They look at the economy as in a very good position. Unemployment's still at 4.2%. There's not massive bankruptcies. Companies are in very good shape. Most consumers have good balance sheets. If the Federal Reserve is not overly concerned today about next year's inflation or the next 5 years' inflation, I'm not sure we should be as concerned about it either. And again, even if it goes up, I think it's all manageable. And if the Fed continues to lower short-term rates, that's going to be good for us. So in summary, yeah, the tariffs have caused major volatility. It hasn't been fun, but we've been through lots of volatility in the past. We never had COVID before either. We never had a financial banking collapse. We're going to get through this. The economy is actually in great shape right now, timing-wise, to get through it. So we feel comfortable that we're going to continue the investment process we have today and the type of things we're looking at. We're not selling anything. We might be looking to add things, but we feel structurally positive over the next 5 to 7 years on the U.S. economy and the stock market. With that, I'm going to turn over to my son, John, to talk about the markets and talk about what's going on there. Again, if you have questions, you will have a chance to submit those to our service or call us in and give it to it. We can follow up next week if you have questions on the presentation today.
Well, thanks for that. Now we're going to talk a little bit more about the markets. So the economy was, a lot of turmoil. People were scared. People were worried about inflation expectations, and they were worried about market uncertainty or policy uncertainty. This is a chart that, if you look at, it's going to look very similar to something we saw earlier. Why? It's a chart of volatility, and it's going to match up really well with policy uncertainty. But this is the CBOE's volatility index. This is how we measure using options, how volatile the market is. And we saw some pretty wild swings here. We saw an 8% move on a Wednesday last week. Now, this is underrepresented. This is the closing numbers. At one point, it was 60 some in the middle of the day last week. It was really, really high. We haven't seen, when you see these sorts of numbers, there's always scary things, right? When else have you seen policy uncertainty? Yeah, obviously the global financial crisis. But a few years later, we saw it during the European financial crisis. Yeah, the U.S. didn't have a recession after that, but it was a big volatility and spike, a big spike in volatility. We saw a big move in 15 and 16. We saw one in 18 when the Fed was raising rates too fast to fight off inflation that didn't ever show up, right? It took several more years to get inflation going. COVID, we had a lot of uncertainty. The invasion of Ukraine, a lot of uncertainty. And then today, a lot of uncertainty, a lot of volatility. And why wouldn't people be experiencing this volatility? People are pretty upset at the moment. So if you look at this chart, I'm going to go through it very briefly. This is the Michigan Consumer Confidence Chart. Today, April, we got the number last Friday, and it was pretty bad in March, even before we got tariffs. It was like 56. Today it's 50.8. We are about to we're pretty close to setting an all-time low over the last 55 some odd years for consumer confidence. And if you look at these, there's all these dots here that at the around there. There's blue dots at the top and the bottom. The top is when things go great. And when are people most excited? January of 2000. How did the market do the following 12 months? The answer is dismal, right? When else have people been excited? January of 15, and the market was dismal for the next 12 months. January 2007, right? But when have people been least excited, right? May of 1980, right? October of 1990, November of 2008, right around when we were finally starting to bottom. August 2011, that was the European financial crisis. June of 22, of course, we just talked about we had 9.1% in inflation, and we bottomed in that October. I mean, so when you look at this, when people are most upset is usually probably when we're closer to the bottom, and the returns on the 12-month forward-looking basis are usually pretty positive because we get these corrections every year. But yeah, why would anybody feel good? We had very, very high policy uncertainty. With inflation, one of those questions you do have is, are people fighting the last war? We just saw that chart about inflation expectations that rocketed forward. Long-term inflation expectations hadn't changed for years. And sometimes people can get overly excited about those things. And that's why you get volatility in the market. So this is a chart of volatility of the S&P 500 and the corrections that happened since 1980. If you look at this, there's two things in this chart. There's the bars, which is how the year ended up. And then there's the red dots, which is the intra-year corrections. If you look closely at this, since 1980, there are a lot of them with two numbers in them, or a lot of double digits. We were actually down 19%, right? Through last Friday was the maximum we went down. We ended up down 9% through last Friday. Why is that important? Well, there's a lot of periods where this has happened. And it doesn't mean you don't make money. Even 1987, you lost 23% in a day. The market still was up 2% that year. So you can have big volatility swings, and things can still work out all right. Why am I talking about 10%, 20%, 19% specifically? Well, because bear markets. Bear markets are 20% drawdown. Corrections are only 10. Right now, we're still in a correction. We haven't crossed to 20. And mark my words, about a year from now, somebody will say, it's been a while since we've had a good bear market. Even though we're going to be down 19.5% peak to trough here as of last week. But if you're only down 10, right, or 10 or more, what happens, since 1980, what happens during those periods if you either do or do not have a recession? Because that's the word on everybody's lips right now. Unemployment still looks incredibly strong. The consumer still looks incredibly strong. Growth prospects still look incredibly strong. The onshoring story we've been talking about for years still looks incredibly strong. But if we do have a recession, how do you end up 12 months from now? And that's in the far right chart. That's the dark line. You end up about where we're at today. Now, what happens if you have no recession? Well, then you actually have a pretty good return for the following 12 months. So are we worried about the market going forward? Again, you always have to ask yourself, am I buying this for the next 5 years or longer? And if I believe the market's going to be up 5 years from now, I can absolutely buy into that story. But yeah, we've not yet hit a bear market, but we're awful close. Starting this year, one of the things we talked about was it was going to be a very challenging year to make money. And we talked about it for a couple of different reasons. One of the key ones was the forward PE ratio. So forward PE is, and this is a simple explanation, at the middle there you see it says 16.9, basically means you're willing to pay $17 to earn $1 every year. And you're hoping, because it's a stock, that next year it's not $1, it's $1.03, and then $1.08, and then $1.12, and it keeps growing. Well, in this case, right, what's happened to earnings recently, 22, remember there was a negative 25% peak to trough. We ended up the year down 19%. Earnings grew that year. We just spent all of it repricing from 22 times down to closer to 16. That was the pullback. 2023, people talk about great year in the market. We're up, 20+%. Earnings were flat that year. Last year was a 20% up year. Earnings were up about 8-9%. Right? So we started this year and said at 22 times, that's where we started this year, it's hard to argue for more multiple expansion. If anything, we're going to have to see earnings come through and we're going to get some multiple contraction. And that's exactly what we've seen. It's also a little bit more concentrated than it used to be. So even when you look back at this chart, even in 2000, 28% of the market was the top 10 names. Today, that's closer to 40%. So the market's even more concentrated than it has been, which means that you really have to focus on those top stocks. Just a few weeks ago, the Magnificent Seven, which I know a lot of people talk about, was trading at roughly 30 times earnings. Today, it's closer to 22. Right, the rest of the market has come down, but the if you're indexing all the time, most of the returns have been driven by just 7 names. It's almost as if the other 493 haven't even counted. But if you look at this at the bottom, the share of returns, starting in 22, 56% of the returns were 7 out of 500 names. 2023, it was almost 2/3 of the return driven by 7 out of 500 names. 2024, over half was driven by the returns of 7 names. Year to date, the returns of the S&P 500 are driven by just 7 names. 60% of the return are driven by just 7 names. If you look here, the S&P 500 year to date is down almost 9, which I just talked about that a minute ago. X the Mag 7, down 3.3. The Magnificent 7 are down 16.7. And this goes back to something we talked about a lot last year, is the overconcentration risk and the fact that people were getting over-levered in these maybe without even realizing it. And what we said is that earnings follow profits, and profits follow earnings. Stocks go up, they're almost perfectly correlated. It's a 0.97% correlation between earnings and returns. You need to see earnings. And if those stocks were going to continue, we said that one of two things was going to happen. Either we'd see them mark time and go sideways as the rest of the market caught up, and what we call a broadening of the market overall, or we'd see those numbers come down on the top stocks with the other 493 names not going down nearly as much. It seems like the latter is what's occurring here in the last few weeks. Is you're watching the top names come down the most, and the other 493 are relatively stable. But if that's the case, it's one of those things where you got to ask yourself again. When you're investing, what looks good for the next 5 years? What looks good for the next 20 years? What looks good for the next 30 years? And you have to get your allocation right. So I'm going to finish on this chart, which is still one of our favorite charts. In the last 30 years, this goes from 1992 to 2022. So, not a crazy period. Just you had the 90s, you had some huge pullbacks in 95, you had two 50% bear markets, you had a global financial crisis, you had 9/11, a couple of world wars, COVID, all the normal stuff. There was a European debt crisis. There was an Asian debt crisis in the 90s there. I think it probably isn't even on the list. But if you invested in U.S. stocks, you return almost 10% annually. Government bonds, 4.6. Inflation was 2.5. What happens if you kept jumping in and out of the market, as we know most individual investors do, based on the fund flows of them getting into funds and out? The average investor returned 4.1. Basically, the two main things they could have bought, U.S. stocks and government bonds, they underperformed them both. And it's a great reminder why allocation is important. It's a great reminder why, even indexing, which has been working really, really well for the last number of years, it's not the end-all be-all. There's no one end-all be-all strategy. But with that, I want to talk to people about tariffs. Yeah, tariffs are a big deal. There's a lot of policy uncertainty around it. Ultimately, the market sees through these things. The market's looking forward. The market is looking toward next year's earnings. Additionally, yeah, it's a very volatile period, but it's periods like this that allow the market to be up as much as it has been, is because of these sorts of volatility. And what we said starting this year is that it was going to be a more challenging year to make money, and we didn't want to take an overweight to chase performance. Turns out to be real in line with what we've seen here in the last few weeks. With that, again, we'll take questions as they come up, especially expanding on this for next week. We're going to conclude there.
Yeah, I think that was great. And again, things will change. This will get better.